Something remarkable just happened in the precious metals markets. And if you're watching this video, you likely noticed it too. Gold and silver both surged following Federal Reserve Chair Jerome Powell's latest remarks. Not a modest tick upward. A decisive, meaningful move that caught the attention of institutional traders, wealth managers, and everyday investors alike. This wasn't random noise. This was the market speaking clearly about what it heard, and more importantly, what it expects to happen next. The question now isn't whether this move matters. It does. The question is what this movement tells us about the broader forces reshaping our financial landscape, and how thoughtful investors should position themselves in response. Over the next 25 minutes, we're going to examine this development with the seriousness it deserves. No hype, no predictions of overnight wealth, just clear analysis from someone who's studied these markets for years and understands what drives them beneath the surface. We'll explore why precious metals responded this way to Powell's words. We'll examine the historical patterns that give context to this moment. And we'll discuss specific, rational strategies for both current holders of gold and silver and those considering whether now is the time to establish a position. Because here's what experience teaches us. The investors who succeed in volatile times aren't the ones who react emotionally to every headline. They're the ones who understand the deeper currents, who prepare systematically, and who maintain discipline when others lose theirs. This is one of those moments that could define portfolio outcomes for years to come. Let's make sure you understand it fully. Let's start with the fundamental question. What exactly did Powell say, and why did precious metals react so strongly? Powell's remarks contained signals about the Federal Reserve's evolving stance on monetary policy. The specific language matters less than the underlying message. The Fed's path forward may not be as restrictive as markets had priced in. Whether through comments about inflation trends, employment data interpretation, or the balance sheet trajectory, Powell communicated something that shifted expectations. And precious metals, those ancient stores of value, responded immediately. Gold jumped, silver followed, often with even greater percentage moves due to its smaller market size and dual nature as both precious metal and industrial commodity. The speed and magnitude of these moves tell us that large institutional players were repositioning quickly. But let's be clear about what's really happening here. This isn't just about one speech or one data point. This is about a fundamental recalibration of risk, value, and monetary policy expectations that's been building for months. To understand this moment, you need to understand where we've been. The Federal Reserve raised interest rates aggressively to combat inflation that reached levels not seen in 4 decades. This was the fastest tightening cycle in modern history. Higher interest rates traditionally create headwinds for gold and silver. Why? Because these metals don't pay interest or dividends. When risk-free Treasury yields rise substantially, the opportunity cost of holding precious metals increases. Money flows toward instruments that generate income. This is basic portfolio theory, and it played out exactly as expected through much of the tightening cycle. Gold faced pressure. Silver faced even more pressure due to its industrial demand sensitivity to economic slowdown concerns. But something changed. Markets began pricing in a pivot, not an immediate reversal, but a shift in trajectory. Powell's latest remarks validated some of those expectations, or at least didn't push back against them as forcefully as some anticipated. When the expected path of interest rates shifts lower, even marginally, the opportunity cost calculation for precious metals changes. Suddenly, holding an asset that preserves purchasing power without counterparty risk becomes more attractive relative to bonds yielding less than previously projected. This is the mechanical explanation. But there are deeper forces at work. Gold and silver have served as money for thousands of years, not because of arbitrary tradition, but because they possess qualities that make them reliable stores of value across time and geography. They're scarce, they're durable, they're divisible, they're fungible, and crucially, no government or central bank can create them at will. This last point becomes increasingly relevant as central banks navigate unprecedented monetary challenges. The expansion of central bank balance sheets over the past 15 years has been extraordinary by historical standards. Quantitative easing programs, emergency lending facilities, direct government financing during crises, these tools were once considered extreme measures. Now they're standard components of the monetary policy toolkit. Each time a central bank expands its balance sheet, each time new currency units are created, the existing units become marginally less scarce. This doesn't necessarily cause immediate inflation. Money velocity, credit creation, and real economic output all play crucial roles. But it does create a fundamental tension. How much expansion is too much? At what point does confidence in fiat currency begin to erode? These aren't abstract concerns. They're questions that institutional investors, sovereign wealth funds, and central banks themselves are asking as they diversify reserves. When Powell speaks, he's not just communicating about interest rates, he's communicating about the Fed's approach to managing this tension between supporting economic growth and maintaining currency stability. And precious metals, sensitive instruments that they are, reflect the market's collective judgment about how successfully this balance is being maintained. This isn't the first time we've seen precious metals respond strongly to shifting monetary policy expectations. History offers valuable perspective. Consider the 1970s, the last period of sustained high inflation before our recent experience. Gold rose from $35 per ounce at the start of the decade to over $800 by January 1980. This wasn't a bubble driven by speculation alone. It was a rational response to genuinely deteriorating currency purchasing power. The Federal Reserve under Paul Volcker eventually broke inflation's back with interest rates exceeding 15%. Gold subsequently entered a two-decade bear market as confidence in the dollar's stability was restored through painful but necessary policy discipline. Then came the 2000s. Following the dot-com crash, and especially after the 2008 financial crisis, gold entered another major bull market. From under $300 in the early 2000s, it climbed to over $1,900 by 2011. Again, this reflected concerns about monetary expansion, zero interest rate policy, and quantitative easing programs. Each of these major moves in precious metals wasn't random. Each reflected fundamental changes in the monetary environment and investor confidence in fiat currency stability. We should also remember that precious metals don't move in straight lines. The 2011 peak was followed by years of consolidation and decline. Gold fell to around $1,000 by late 2015 before beginning another ascent. These cycles teach us important lessons. Precious metals respond to real forces, but they also overshoot in both directions. Timing is exceptionally difficult, and the investors who do best are typically those who maintain positions systematically rather than trying to trade every swing. Let's address something that makes many traditional financial advisors uncomfortable. Precious metals are partially driven by fear, not irrational panic, but rational concern about systemic stability. When investors worry about currency debasement, banking system fragility, geopolitical instability, or policy errors, they seek assets that exist outside the traditional financial system. Gold and silver fulfill this role uniquely. They're no one else's liability. They don't depend on any institution's solvency. They've maintained value across millennia through countless monetary regime changes. This fear premium waxes and wanes with perceived risk. During periods of confidence in economic growth, stable inflation, and sound monetary policy, this premium compresses. Investors feel comfortable in paper assets and see no need for monetary insurance. But when confidence wavers, even slightly, the fear premium expands rapidly. And because precious metals markets are relatively small compared to bonds and equities, capital flows can move prices substantially. Powell's recent remarks may have inadvertently reinforced certain concerns while attempting to reassure on others. When the Fed discusses its data-dependent approach, markets hear uncertainty. When it discusses balancing multiple objectives, markets wonder which objective might be sacrificed if push comes to shove. This isn't criticism of Powell or the Fed. Central banking is extraordinarily difficult, perhaps impossible to do perfectly. But the difficulty itself is part of what drives precious metals demand. Investors are asking themselves a fundamental question. In a world of massive sovereign debts, aging demographics, productivity challenges, and geopolitical tensions, how will central banks navigate the path ahead? The answer isn't obvious, and when the answer isn't obvious, insurance assets become more attractive. Beyond monetary policy and psychology, we should consider the physical market fundamentals that underpin precious metals. Gold mining production has been relatively flat for years. The easy deposits have been found and exploited. New discoveries are rare and increasingly expensive to develop. Meanwhile, global demand remains robust, from jewelry in India and China, from central bank reserve accumulation, from investment demand worldwide. This creates a supply-constrained environment. When investment demand surges in response to monetary concerns, available supply can't expand quickly to meet it. Prices must rise to clear the market. Silver faces even tighter supply-demand dynamics. It's primarily produced as a byproduct of copper, lead, and zinc mining. When industrial metals demand falls, silver supply can actually decline regardless of silver's price, because the economics are driven by the primary metal being extracted. Meanwhile, silver has unique industrial applications in solar panels, electronics, and other technologies. This industrial demand provides a floor under prices that gold doesn't have. The combination of monetary demand and industrial demand creates interesting dynamics. Silver often lags gold initially during monetary stress, but then catches up explosively once the move is confirmed. Experienced precious metals investors watch this gold to silver ratio carefully for signals about market phase transitions. Understanding these fundamentals helps us avoid being shaken out by normal volatility. If you believe the underlying supply-demand picture supports higher prices over time, short-term fluctuations become easier to withstand psychologically. One of the most significant developments in precious metals markets over the past 15 years has been the return of central banks as net buyers of gold. For decades, central banks were net sellers. They viewed gold as a barbarous relic, unnecessary in a modern monetary system based on managed fiat currencies and liquid government bond markets. This changed after 2008. Central banks in emerging markets, particularly China, Russia, Turkey, India, and Poland, began accumulating gold reserves aggressively. Even some developed nation central banks slowed or halted their selling programs. Why does this matter? Central banks have access to information and analysis that retail investors can only dream of. They employ PhDs in economics. They participate in international monetary forums. They understand currency system fragilities from the inside. When these institutions collectively decide to increase their gold holdings, they're making a statement about systemic risk and the long-term role of gold in a diversified reserve portfolio. This isn't a short-term trading signal. Central banks think in decades, not quarters. But their behavior confirms that sophisticated institutional actors view gold as an essential strategic asset, not a speculative gamble. For individual investors, this should provide confidence that precious metals allocation isn't fringe thinking. It's prudent diversification practiced by the most conservative institutions in the global financial system. Here's a concept that professional precious metals traders use to understand price drivers: real yields. Real yield is simply the nominal interest rate minus the inflation rate. If 10-year Treasury bonds yield 4% and inflation is running at 3%, the real yield is 1%. Gold historically shows an inverse correlation with real yields. When real yields rise, gold faces headwinds. When real yields fall or go negative, gold tends to perform well. Why does this relationship exist? Because real yields represent the actual opportunity cost of holding gold. If you can earn a positive real return in risk-free government bonds, holding gold means foregoing that real return. But if real yields are negative, meaning bonds guarantee a loss of purchasing power after inflation, gold's lack of yield becomes less of a drawback. Powell's recent remarks likely affected market expectations about the path of real yields. If investors now anticipate lower nominal rates than previously expected, and inflation remains above target, the real yield trajectory looks less attractive for bonds and more attractive for gold. This framework helps remove emotion from the analysis. You don't need to predict specific prices. You simply need to assess the likely path of real yields and position accordingly. We must acknowledge that precious metals don't trade in a vacuum. Geopolitical tensions materially affect demand for monetary safe havens. The current global environment features elevated tensions on multiple fronts: the ongoing conflict in Eastern Europe, strategic competition between major powers, Middle East instability, questions about the durability of the post-World War II international order. Each of these situations carries risks of escalation. Each creates uncertainty about economic stability, energy supplies, currency arrangements, and the security of financial assets held within the traditional banking system. Gold and silver serve as hedges against these geopolitical risks. Not perfect hedges, nothing is perfect, but meaningful diversifiers that behave differently than paper assets during crises. When Powell discusses the Fed's policy path, he's implicitly discussing how the U.S. will manage its economic and fiscal challenges. Those challenges don't exist in isolation. They interact with America's global role, the dollar's reserve currency status, and international confidence in U.S. institutions. The world is watching. And as they watch, some are quietly diversifying away from dollar-heavy reserve positions into gold. Not to abandon the dollar, that remains impractical for most international transactions, but to balance concentration risk. This gradual portfolio rebalancing by foreign central banks and sovereign wealth funds creates persistent bid for physical gold that supports prices even during periods when Western investment demand might be weak. Now that we understand the forces at play, let's discuss practical implications. Your situation determines your appropriate strategy. Let's examine two primary groups. If you already own gold and silver, this recent price surge might feel validating. Perhaps you've held through periods of doubt and criticism. Perhaps you've watched your position lag while stocks and bonds performed well. Now you're seeing movement. Here's your first decision point. Do you take profits? Do you hold? Or do you add to positions? The answer depends on your original thesis. Why did you buy precious metals in the first place? If you bought them as portfolio insurance against monetary instability, has that risk disappeared? If you bought them as long-term stores of value, has something fundamentally changed about their role in your overall wealth preservation strategy? For most holders, the appropriate response is to do nothing. Simply hold. You own precious metals for reasons that likely remain valid. One speech from Powell doesn't resolve the underlying concerns about monetary expansion, sovereign debt levels, and currency stability. Market timers will try to trade these swings. Some will succeed, but many will underperform a simple hold strategy. They'll sell too early, wait for pullbacks that don't come, or miss the big moves while sitting in cash. There's profound wisdom in the old investor adage: Your winners need time to work. If you own an asset that's beginning to move in your favor, the worst thing you can do is cut the position prematurely. That said, responsible position management matters. If precious metals have grown to represent an uncomfortably large percentage of your total portfolio due to recent gains, rebalancing might be appropriate. Not selling out entirely, but trimming back to your target allocation range. This isn't market timing, it's discipline. It's maintaining the risk profile you originally designed for your portfolio rather than letting one position dominate through appreciation. Consider this framework. If precious metals now exceed 25% of your investable assets, and your original target was 10 to 15%, consider selling enough to return to the upper end of your target range. Lock in some gains while maintaining meaningful exposure. The proceeds can be deployed into other portfolio components that may be relatively cheaper. This is strategic rebalancing, not emotional trading. For those holding physical metal, coins and bars in personal possession or allocated storage, the calculus is slightly different. Physical metal carries no counterparty risk, but involves storage costs and sale friction. These holdings are your ultimate insurance layer. They shouldn't be traded tactically. They should be held until circumstances change fundamentally or your life situation requires liquidity. If you hold precious metals exposure through mining stocks, ETFs, or futures contracts, you have more flexibility but also more complexity. These instruments don't move in perfect lockstep with metal prices. Mining stocks carry operational risks. ETFs have expense ratios. Futures require active management and can be dangerous for inexperienced traders. Mining stocks deserve special attention. They provide leverage to metal prices. When gold rises 10%, quality miners might rise 20 or 30%. But they're still businesses, subject to operational challenges, management quality, jurisdictional risks, and equity market sentiment. If you own miners and they've run up substantially, taking some profits can be prudent. These stocks can be extraordinarily volatile. Protecting gains during euphoric periods allows you to redeploy capital when they inevitably pull back. The emotional challenge for current holders is fighting the urge to get too clever. You made a good decision establishing positions. You weathered periods of doubt. Now that thesis is playing out, don't outsmart yourself by abandoning a winning strategy. Remember, the goal isn't to maximize short-term gains. The goal is to have portfolio protection in place when it's needed most. Precious metals insurance is most valuable during the times when everything else is struggling. That scenario may still lie ahead. If you don't currently own precious metals and you're watching this recent price action, you're probably experiencing conflict. Part of you recognizes this might be an important moment. Part of you worries about buying after a surge. This tension is natural. Let's work through it systematically. First, acknowledge that trying to time a perfect entry point is futile. Markets don't work that way. Yes, precious metals could pull back tomorrow. They could also be significantly higher 3 months from now. No one knows with certainty. What matters is whether precious metals serve a legitimate role in your overall portfolio. That depends on your goals, time horizon, risk tolerance, and beliefs about the monetary environment ahead. Consider these questions honestly. Do you believe central banks will successfully manage inflation back to target without recession? Do you trust that sovereign debt levels are sustainable? Do you think currency purchasing power will be preserved over the next decade? If you answer yes to all of these questions with confidence, you probably don't need precious metals exposure. Your portfolio can be concentrated in productive assets, stocks, real estate, businesses. But if you have genuine uncertainty about any of these questions, precious metals deserve consideration as portfolio diversifiers. Not speculation, not a get-rich scheme, but strategic allocation. How much? A reasonable starting point for most investors is 5 to 10% of investable assets. Conservative enough that if you're wrong, it won't devastate your portfolio. Meaningful enough that if you're right, it provides real protection. For those with higher risk tolerance or stronger conviction about monetary concerns, 10 to 15% might be appropriate. Beyond 15% requires sophisticated understanding of precious metals markets and strong emotional discipline during inevitable volatility. The mechanics of entry matter. Buying your entire intended allocation in one lump sum after prices have already moved carries timing risk. You might be buying a local top right before a pullback. A better approach, dollar cost averaging. Divide your intended allocation into 4 to 6 equal purchases spread over several months. This removes the timing pressure and ensures you acquire positions across various price levels. Yes, if prices run higher immediately, you'll wish you'd bought everything at once. But if prices pull back, you'll be grateful you have remaining capital to deploy at lower levels. Over time, this disciplined approach typically produces better average entry prices than trying to time a single purchase. Regarding what to buy. For most investors, physical metal in allocated storage or reputable ETFs backed by physical metal represent the simplest approaches. Avoid complex derivatives, leveraged products, or obscure mining stocks until you thoroughly understand precious metals markets. If you choose physical metal, understand the premium over spot price you'll pay for coins or small bars. This is normal. It covers minting, distribution, and dealer margins. Just factor it into your calculation. You need metal prices to rise by roughly 5 to 10% just to break even after premiums and eventual sale spreads. Allocated storage programs offered by reputable dealers eliminate the physical possession concerns while maintaining direct ownership of specific bars. These programs typically charge annual storage fees around 50 to 100 basis points, but they provide professional vault security and easy liquidity. ETFs like those backed by physical gold or silver offer maximum liquidity and minimal storage hassle. You trade like a stock, and the fund owns physical metal in vaults on your behalf. The main consideration is counterparty risk. You're trusting the fund structure and the custodian. For most investors, this is acceptable. The timing psychology challenge: you're likely feeling urgency right now because prices just moved. This is actually a reason to be cautious. The best buying opportunities typically occur when precious metals feel boring or unwanted, not after attention-grabbing surges. If you feel you must establish some position immediately to avoid missing out, consider deploying perhaps 25% of your intended allocation now, then waiting for at least 2 to 3 weeks before the next purchase. This prevents complete FOMO-driven decision-making while giving you some exposure. The worst possible approach is to panic, buy a large position during a surge, watch it pull back 10 or 15%, then panic sell at a loss. This pattern destroys wealth reliably. Avoid it through measured, disciplined position building over time. One final consideration for new investors. Understand that precious metals ownership doesn't generate income. You won't receive dividends or interest. Your return comes entirely from price appreciation. This means precious metals are suitable for the portfolio allocation you don't need to generate cash flow. If you require all your investable capital to produce current income, precious metals may not be appropriate. But if you can afford to set aside capital for pure capital preservation and appreciation, they deserve serious consideration. Now we need to discuss what not to do. Over years of watching precious metals markets, certain patterns of destructive behavior appear repeatedly. Learn from others' mistakes rather than experiencing them yourself. Precious metals can be extraordinarily volatile. 20% moves in relatively short periods aren't unusual. This volatility triggers emotional responses that lead to poor decisions. When prices surge rapidly, euphoria sets in. You'll see predictions of gold reaching $5,000 or $10,000. You'll feel like a genius for owning it. You might be tempted to overconcentrate, adding more at elevated prices. This is dangerous. Surges are often followed by consolidation or retracement. Buying heavily during euphoric periods means buying from people who are taking profits after holding through the entire move. You're providing their exit liquidity. Equally dangerous, when prices pull back sharply, fear sets in. You'll question your original thesis. You'll see commentators declaring the move over. You'll be tempted to cut losses. This creates the classic pattern of buying high and selling low, wealth destruction in its purest form. The cure is having a plan before you establish positions and following that plan regardless of emotion. Write down why you're buying precious metals. Write down what conditions would need to change for you to sell. Review this document when you feel emotional. It provides perspective that your stressed mind cannot generate in the moment. Some investors try to amplify returns through leverage, buying precious metals on margin, trading futures contracts, or using option strategies. For experienced traders with proper risk management, these tools have legitimate uses. For most investors, they're wealth destroyers. Leverage amplifies both gains and losses. A 10% move against a leveraged position can wipe out your capital. In volatile precious metals markets, getting temporarily forced out of a position due to margin calls is common, even if your directional view eventually proves correct. The tragic pattern: an investor buys gold futures with high leverage. Prices pull back 15%, margin calls force liquidation at a loss, then prices rally to new highs that the investor can no longer participate in. The move they predicted happened, but they lost money anyway. Stay within your financial capacity. If you can afford to allocate $10,000 to precious metals, buy $10,000 worth at spot prices through physical metal or ETFs. Don't use that $10,000 as margin to control $50,000 worth of futures. The risk simply isn't worth it for long-term wealth preservation. The precious metals space attracts promoters of dubious schemes: rare coins with massive premiums over melt value, shares in pre-production mining companies with no revenue, complex structured products that barely track metal prices. Avoid these traps. If you're buying physical metal, buy common liquid products. American Gold Eagles, Canadian Maple Leafs, or simple gold and silver bars from recognized refiners. These trade with tight spreads and are easily verifiable. If you're buying mining stocks, stick with established producers with operating mines, positive cash flow, and reasonable balance sheets. Speculating on junior exploration companies is essentially venture capital investing. only for those who can afford total loss. Those exotic products promising enormous returns come with enormous risks that the promoters don't adequately disclose. In precious metals, boring is beautiful. Complexity usually hides danger. Some investors become so focused on precious metals that they forget the purpose of diversification. They overconcentrate, turning what should be portfolio insurance into their primary holding. This creates unnecessary risk. If precious metals enter another extended consolidation phase, like 2011 to 2015, you'd be stuck with a large position that's not performing. Meanwhile, other asset classes might be generating solid returns that you're missing. Maintain perspective. Precious metals are one component of a balanced wealth preservation strategy. They complement stocks, bonds, real estate, and cash. They don't replace them. A properly diversified portfolio means accepting that some components will underperform in any given period. That's not failure, it's design. The components that underperform during good times are often the ones that protect during bad times. If you choose physical possession of precious metals, security becomes your responsibility. People make dangerous mistakes here. Don't tell friends, relatives, or casual acquaintances about your precious metals holdings. Word spreads, and you create security risks. Don't store large amounts at home without proper security measures. A home safe bolted to foundation studs might suffice for modest amounts, but larger holdings need professional vault storage. Don't skimp on insurance. Standard homeowners policies typically have very limited coverage for precious metals. You may need separate valuable articles, insurance, or vault storage that includes insurance coverage. The goal isn't to be paranoid, but to be appropriately cautious. These are valuable, portable assets. Treat them accordingly. Precious metals face specific tax treatment in many jurisdictions. In the United States, for example, physical gold and silver are classified as collectibles, subject to a maximum 28% capital gains tax rate, rather than the lower 15 or 20% rates for most securities. This creates planning considerations. Holding precious metals in tax-advantaged retirement accounts can shelter gains from these higher rates. Consult with a qualified tax professional about your specific situation before making large transactions. Don't let tax considerations prevent you from taking logical actions, but don't ignore them either. Being surprised by unexpected tax bills because you didn't plan appropriately creates unnecessary financial stress. The precious metals space attracts both irrational skeptics who dismiss metals entirely and zealots who see them as the only worthwhile investment. Both extremes are wrong. Gold and silver aren't going to $10,000 and $500 respectively next month. The monetary system isn't collapsing tomorrow, but precious metals also aren't barbarous relics destined for permanent irrelevance. The truth exists in between. Precious metals serve a legitimate portfolio function as stores of value, inflation hedges, and crisis insurance. They're valuable without being magic. They belong in portfolios without dominating them. When you encounter extreme narratives promising specific price targets or collapsed timelines, maintain skepticism. No one knows the future. Those who claim certainty are either deluded or selling something. Make decisions based on reasonable assessment of risk and opportunity, not end times prophecies or dismissive mockery from traditional finance orthodoxy. We've covered substantial ground together, from Powell's recent remarks and the precious metals response through historical context and market dynamics to specific strategic considerations for different investor situations, and finally to critical warnings about destructive behaviors. Let's bring this together with some final perspective. The recent surge in gold and silver following Powell's comments represents something real. It's not noise, it's the market processing information and adjusting expectations about monetary policy, real yields, and currency stability. Whether this marks the beginning of a major precious metals bull market or merely a temporary spike remains to be seen. The honest answer is that no one knows with certainty. Anyone claiming otherwise isn't being truthful. But here's what we can say with confidence. The fundamental factors supporting precious metals allocation haven't disappeared. Sovereign debt remains elevated, central bank balance sheets remain historically large, geopolitical tensions persist, currency confidence questions remain legitimate. These conditions suggest that precious metals will continue serving their traditional role as portfolio stabilizers and inflation hedges. Not every year will be positive. Volatility will challenge your resolve. But over full market cycles, strategic allocation to gold and silver has historically enhanced risk-adjusted portfolio returns. Your task now is to make rational decisions appropriate to your situation. If you're an existing holder, stay disciplined. Don't let short-term price swings shake you out of positions you hold for sound reasons. Don't get overconfident during surges. Don't despair during inevitable pullbacks. If you're considering establishing positions, do so methodically. Define appropriate allocation levels. Implement through dollar-cost averaging. Choose simple liquid products. Avoid leverage and exotic schemes. Most importantly, everyone should maintain perspective. Precious metals are tools, not religion. They're portfolio components, not identity statements. They serve specific functions without being magic solutions to all financial challenges. The investors who succeed over decades share common traits. They make decisions based on analysis rather than emotion. They maintain diversification rather than over-concentrating. They stick with strategies during difficult periods rather than abandoning them at exactly the wrong time. They understand that wealth preservation requires patience, discipline, and sometimes enduring periods when your strategy looks foolish to others. They have the courage to be contrarian when appropriate, and the wisdom to avoid contrarianism for its own sake. As you move forward from here, remember that your greatest asset isn't predictionability. It's preparation combined with discipline. You can't predict the next Federal Reserve decision or the next geopolitical crisis, but you can be prepared for various scenarios through thoughtful portfolio construction. Precious metals represent one component of that preparation. Not the only component, but a meaningful one with historical justification. Whether recent price moves continue or pause, that underlying logic remains valid. The financial landscape ahead contains genuine uncertainty. Inflation paths, growth trajectories, policy responses, all involve considerable unknowns. This uncertainty isn't cause for panic. It's the normal state of affairs that investors have always navigated. You navigate it through preparation, diversification, and emotional discipline. You build portfolios that can withstand various scenarios rather than betting everything on one outcome. You maintain cash reserves for opportunities. You avoid leverage that could force you out of positions at inopportune moments. And you stay informed without becoming obsessed. You monitor developments without overreacting to daily noise. You adjust positions when circumstances genuinely change, not in response to fear or greed. This measured approach won't generate exciting stories. You won't double your money in a month, but you also won't blow up your portfolio chasing exciting stories. Over time, this discipline compounds into genuine financial security. That security matters more than spectacular short-term gains. It provides freedom from financial anxiety. It ensures you can meet obligations regardless of market conditions. It gives you the stability to focus on what matters most in life beyond portfolio values. As we close, consider this. The fact that you're watching this video and taking time to understand these dynamics places you ahead of most investors. The majority make financial decisions reactively based on headlines and emotions, without deeper understanding. You're choosing a different path. You're investing time in education. You're thinking strategically about portfolio construction. You're considering both risks and opportunities with appropriate seriousness. This approach won't guarantee specific outcomes. Markets are too complex, influences too numerous for guarantees. But it dramatically improves your probability of long-term success compared to reactive, emotional decision-making. So take what you've learned here and apply it thoughtfully to your situation. Have conversations with financial advisors if you work with them. Do additional research to deepen your understanding, but ultimately make decisions that let you sleep at night while positioning you reasonably for various potential futures. The precious metals market will continue evolving. Powell will make more statements, economic data will fluctuate, prices will move up and down, sometimes dramatically. Through all of it, maintain your discipline and perspective. Because at the end of the day, successful investing isn't about predicting the future perfectly. It's about being reasonably prepared for various futures and maintaining the emotional composure to stick with sound strategies even during inevitable periods of doubt. You have the knowledge now to make informed decisions about precious metals allocation. You understand the forces driving markets, the strategies appropriate for different situations, and the mistakes that destroy wealth. Apply this knowledge wisely, and you'll be positioned well, regardless of how events unfold. Thank you for your time and attention. Stay informed, stay disciplined, and above all, stay rational. Your financial future will thank you.